Welcome to Financial Wizardry 101. Today, we will be talking about one of the most powerful and, well, often misunderstood financial instruments, the call option. If you're already sort of familiar with the basics, prepare to dive deeper. We're really going beyond just what it is today.
Right. We want to explore the strategic side, the nuances, the practical stuff.
Exactly. The things that, separate seasoned investors from maybe more casual observers. You'll see how these contracts, they aren't just complex jargon.
Not at all. They offer some pretty unique opportunities, things like leverage, speculation, even managing risk in your portfolio.
Yeah, and what's really fascinating, I think, is how a pretty simple core idea, something from like the real world, translates into this sophisticated tool in the markets.
It really does. We'll illustrate that connection, then kind of peel back the layers, look at the dynamics underneath that really drive option pricing and strategy.
Okay, let's do that. Let's anchor this with a concept that's pretty relatable.
Yeah.
Imagine two friends, Alice and Bobby. Bobby owns this, let's say, prime 1-acre piece of land, currently valued at maybe $500,000.
Got it. Standard property.
Right. And Alice is interested, but there's this big if. There's a rumor, a new highway project might get sanctioned near Bobby's land, maybe in the next 6 months.
The classic potential catalyst.
Exactly. If that highway happens, the land value could just, boom, skyrocket. If it's just hot air, well, the land might stagnate, maybe even drop a bit.
So that puts Alice in a tricky spot, doesn't it? How does she capture that potential big upside?
Right.
If the highway gets built, without having to commit the full $500,000 now and risk losing a chunk if it falls through.
That's the puzzle. She needs a way to secure the opportunity, but without taking on all that immediate downside risk.
And this is precisely the kind of problem that options thinking can solve.
Perfect setup. So Alice goes to Bobby with, let's call it, a unique arrangement, a special agreement.
Right.
She offers him a fee, a non-refundable agreement fee, let's say $100,000.
So serious money, but not the full price.
Correct. In return for that fee, Bobby is obligated to sell her the land at its current value, $500,000, any time in the next 6 months, if Alice chooses to buy.
The key part. If Alice chooses, she has the right, but not the obligation.
Exactly. She can walk away.
And that structure, right there, that's the absolute essence of a call option. Alice pays a fixed sum, the $100 K.
The fee?
For control, for optionality, her financial risk.
Yeah.
Capped. It's just that fee.
It's $100,000 max loss.
Right. Bobby, on the other hand, he gets that fee, which is nice. That's his maximum gain here. But he takes on an obligation. He has to sell at that fixed price, no matter how high the land value might go. It introduces that asymmetry.
That risk-reward imbalance. Okay, let's quickly walk through the possibilities over those 6 months. Scenario 1, the highway project. It's approved. Big news.
Okay, check her.
Land value shoots up. Let's say it doubles to $1 million. What does Alice do?
Well, she's definitely exercising her right. No-brainer. Why pay $1 million on the open market?
When she can get it for $500 from Bobby. Exactly.
So her total cost is the $500 K purchase price plus that $100 K fee she already paid.
Right, $600,000 total outlay.
And the land's worth $1 million, so if she flips it immediately,
she pockets $400,000 profit on just that $100,000 agreement fee investment.
That's a 4x return. Incredible leverage.
Incredible. And Bobby.
Well, Bobby's obligated. He has to sell at $500K. He missed out on that extra $500,000 appreciation.
Ouch.
Yeah. He keeps the $100 K fee, sure, but his opportunity cost, his notional loss is huge.
Okay, scenario 2. The highway project. Just a rumor. Fizzles out. Land value actually drops, say, to $300,000.
Okay, the downside case.
What's Alice's move?
She walks away. Simple as that. Why on earth would she pay $500 plus the $100 K fee sunk cost?
So $600K total.
When she could just buy identical land next door for $300. Makes no sense.
So her outcome?
Her loss is strictly limited. It's just that $100,000 agreement fee she paid up front. That's it. Her maximum possible loss defined from the start.
And Bobby?
Bobby just keeps the $100,000 fee. No sale happened. He's better off than if he'd sold at the lower price, I suppose.
Okay, final scenario. Number 3. Nothing really happens. Highway may be delayed indefinitely. Land price just stays flat at $500,000.
The sideways case.
Alice's action.
She probably walks away again, right? Why pay Bobby $500K, effectively making her cost $600K with the fee?
When she could buy it on the market for $500.
Yeah. Doesn't make financial sense to exercise.
So her loss is, again,
limited to that $100,000 fee.
And Bobby
keeps the $100,000.
Okay. So this land deal really paints the picture.
It perfectly illustrates that fundamental asymmetry, doesn't it? For Alice, the buyer, her downside is absolutely defined by that upfront fee. Her upside, potentially unlimited, theoretically.
If the land went to $2 million, $3 million.
Exactly. For Bobby, the seller, his upside is capped. He only gets the fee. But his potential losses, or misgains, are theoretically unlimited if the assets skyrocket.
And that core dynamic, that's what gets replicated directly in the financial markets with options.
Precisely.
So let's make that jump. How does this translate from land to, say, the stock market?
Okay, direct translation time. In the stock market, the land is what we call the underlying asset.
Like shares of a company, maybe an index like the NASDAQ.
Exactly. Stocks, ETFs, indices. Alice's agreement fee, the $100K, that's the premium in options talk.
Okay, the premium.
The fixed price Alice could buy the land for, the $500K, that's the strike price.
Strike price. Got it.
And that 6 months window Alice had, that's the expiry date of the option contract.
Makes sense. Underlying, premium, strike price, expiry date.
Those are the key building blocks.
All right, let's use a stock example. Imagine some hot tech stock trading at $70 a share right now.
Okay.
If you think it's going higher, you're bullish.
Okay.
Now, you could buy 100 shares outright, costing you $7,000.
Right, significant capital outlay.
Or you could use a call option. Let's say you pay a premium of $5 per share for the right to buy this stock at a strike price of $75.
Okay, $75 strike.
And let's say this option expires in 1 month. Now remember, one option contract usually controls 100 shares.
Right, so that $5 premium per share means the contract cost you $500 total. 5 by 100 shares.
Exactly. $500 to control $7,000 worth of stock exposure in a way. That's the leverage.
Okay, so you've paid your $500. Let's see how the market scenarios play out now. Case 1. The stock does what you hoped. It rallies. Goes up to $85 before expiring.
Nice.
Your option, with its $75 strike price, is now in the money because the stock price, $85, is above the strike, $75.
Right, by $10.
So you can exercise your right. Buy 100 shares at $75, even though they're trading at $85.
So what's your effective cost per share?
It's the $75 strike price plus the $5 premium you paid. So $80 per share is your break-even point, effectively.
Right.
Since it's at $85, you could exercise, get the shares at $75, your account debited, and then immediately sell them in the market for $85.
What's the profit then?
You make $5 per share profit, $85 sale price, $80 effective cost. On 100 shares, that's $500 profit.
So you doubled your initial $500 investment.
Exactly. That's the power of leverage working for you.
Okay, case 2. The stock goes the wrong way. It drops to $65.
Ouch. Now your $75 strike call option is out of the money.
Meaning the stock price is below the strike.
Right. Does it make any sense to exercise your right to buy at $75?
When you can just buy it for $65 in the open market? Nope.
Absolutely not. So in this case, you simply do nothing. You let the option expire worthless.
And your loss.
It's precisely limited to that $5 premium per share you paid initially, $500 for the contract. That's your maximum loss, known right from the start.
Okay, that really clarifies the fixed risk for the buyer. So just to nail it down, what's the sort of textbook formal definition we should keep in mind?
Okay, formally, a call option buyer acquires the right, but crucially not the obligation, to purchase an agreed quantity of an underlying asset from the seller at a predetermined price, the strike price, by a specific expiration date.
Right, and they pay for that, right?
Yeah, correct. The buyer pays a non-refundable premium for this privilege. Now, the flip side, the seller, often called the writer of the option, they accept that premium, and in return, they assume the obligation to sell the underlying asset at the strike price if and only if the buyer decides to exercise their right.
So the seller gets the premium, but takes on the obligation. Buyer pays the premium, gets the right.
Precisely. That's the core transaction.
All right, with that foundation, let's quickly recap the key jargon. We've mentioned them, but let's lock them in.
Good idea. Terminology is crucial here.
First, underlying. That's the asset itself, right? The stock, the ETF, maybe an index like the NASDAQ.
Yep. And remember, options trade in lot sizes, typically 100 shares per contract for stocks. This magnification is key for understanding leverage and risk.
Right, 100 shares. Then expiry, that's simply the date the contract ceases to exist.
Correct, the deadline. Options have various expiries, weekly, monthly, quarterly, even years out. Shorter-term options decay faster.
Okay, strike price. That's the agreed-upon purchase price.
Yeah.
Like the $500 for the land or the $75 for the stock.
Exactly, and there are usually many strike prices available for the same underlying and expiry date, above and below the current price.
Which lets you choose how aggressive you want to be, kind of.
Precisely. It determines if the option starts in the money, strike below market price for a call, at the money, strike near market price, or out of the money, strike above market price.
Got it. And premium, that's the cost of the option contract itself.
Right, the non-refundable fee the buyer pays the seller. And unlike our static land example fee, this premium in the market is dynamic. It changes constantly.
Minute by minute.
Absolutely. Driven by the underlying price, time left, volatility, lots of factors. We can maybe touch on those. It actually has two components, intrinsic value and time value.
Okay, intrinsic and time value. And lastly, the regulator. Who oversees all this?
The stock exchanges themselves manage these contracts, ensuring integrity, and settlement differs, right? Index options, like on the NASDAQ, usually cash settled.
Meaning profit or loss is just cash changing hands.
Yep, no shares involved. But individual stock options, if you hold an in-the-money call until expiry, that can often result in physical delivery.
So 100 shares of the stock actually appear in your brokerage account, and you pay the strike price.
Potentially, yes. It's an important practical point to understand with your broker.
Definitely. Knowing these terms is step one. But the real game is how they interact, right? Especially how they affect that premium.
Exactly. The underlying stock price is a big driver, obviously, but it's far from the only thing influencing that option premium.
Yeah, that leads to something I think trips people up.
Yeah.
The difference between just booking your profit on an option versus actually exercising it.
Oh, huge point. Very common misconception. Most people trading options, especially retail traders, almost never exercise them in the traditional sense.
Really? So they don't hold till expiry and take the shares?
Very rarely for active trading. The vast majority of option positions are closed out before expiry. We call it squaring off.
Squaring off, meaning?
Meaning, if you bought a call option and its premium increased because the stock went up or volatility changed, you simply sell that same option contract back into the market to someone else before it expires.
Ah, so you trade the option itself, not necessarily the underlying stock.
Exactly. Your profit or loss is just the difference between the premium you received when you sold it minus the premium you originally paid times 100 for the lot size.
That seems much simpler and avoids dealing with the shares directly.
It is. It allows active management. Exercising, leading to that physical delivery of shares, typically only happens if you deliberately hold an in-the-money stock option right through the moment of expiration. You need to know your broker's rules on auto-exercise.
Good to know. Avoid surprises.
All
Okay,
right.
now, to really get into the weeds, the stuff that separates, the pros, we need to talk about the Greeks, right?
Ah, yes, the Greeks. Not ancient philosophers, they're risk measures. They tell you how sensitive your options price is to different factors, essential stuff.
Okay, let's break down the main ones. Maybe start with delta.
Sure, Delta's probably the most intuitive. It basically tells you how much the options premium is expected to change for every $1 move in the underlying stock price.
Okay, so if a call option has a delta of, say, 0.50,
It means if the underlying stock goes up by $1, you'd expect the options premium to increase by about 0.50 cents, all else being equal.
and delta isn't fixed, right? It changes.
Correct. It ranges from 0 to 1 for calls. A deep-in-the-money call acts almost like the stock. Its delta will be close to 1. And way out-of-the-money call has a low delta, maybe 0.10, barely moving with the stock. Delta also acts as a rough proxy for the probability of the option expiring in the money.
Interesting. Okay, what about theta? Sounds ominous.
Huh. It kind of is, for buyers anyway. Theta is time decay. It measures how much value an option loses each day just due to the passage of time, assuming nothing else changes.
Like melting ice.
Perfect analogy. It's a ticking clock, constantly eroding the option's time value premium. This works against the option buyer.
So you need to be right about direction and timing.
Precisely. If the stock just sits there or takes too long to make its move, theta will eat away at your premium, even if you're ultimately right on direction. For option sellers, though, theta is their friend. They collect premium and hope time decay works for them.
Okay, buyer beware of theta. What's vega?
Vega measures sensitivity to volatility, specifically changes in the implied volatility of the underlying asset.
Implied volatility, like the market's expectation of future price swings.
Exactly. When implied volatility goes up, option premiums generally get more expensive because there's a perceived higher chance of a big move. Vega tells you how much your option price will change for a 1% change in implied volatility.
Does buying options when volatility is already super high, like before earnings?
Can be dangerous. Even if the stock moves your way, if volatility collapses after the news is out, what we call a volatility crush, the drop in premium due to Vega can wipe out your gains from the price move.
Wow. Okay, that's tricky. One more major one. Gamma.
Right, gamma. This one measures how much the delta changes for every $1 move in the underlying stock. Think of it as the acceleration of the option's price movement.
Acceleration.
Yeah. Options that are close to the strike price at the money tend to have the highest gamma. This means their delta is very sensitive to small moves in the stock price. As the stock moves, the delta changes rapidly.
So the option starts behaving more or less like the stock very quickly if it moves into the money.
Exactly. That convexity is why those slightly out-of-the-money options, while cheaper, can explode in value if the stock makes a sharp move towards or through the strike price. High gamma means big potential swings, but also more risk for sellers as their exposure changes fast.
Okay, delta, theta, vega, gamma. It's clear why just having a view on the stock's direction isn't enough.
Not even close for consistent success. You could be right on direction, but if theta decay is too strong or vega works against you because volatility drops, you can still lose money on your call option.
It's a multidimensional game.
Absolutely, which is why options are used for specific strategies, not just plain betting.
So beyond just speculation, what are the strategic advantages for someone who understands this stuff?
Well, we saw the leverage, right? Controlling a lot of stock value for a smaller premium cost, amplifying potential percentage returns.
Definitely.
Then there's the defined risk for buyers. You know your maximum loss upfront, the premium paid. That's hugely attractive compared to buying stock on margin, for example.
Makes sense for high conviction bets.
Right. Options can also be used for hedging. Say you're short a stock, worried about a sudden spike up. Buying a call option can cap your potential losses on that short position, like insurance.
Using a call defensively. Interesting.
And while we're focused on buying, there's income generation from selling or writing options. A very common strategy is the covered call, owning 100 shares of stock and selling a call option against it to collect the premium.
Generating extra yield on stocks you already own.
Precisely. A way to enhance returns, though it caps your upside on the stock.
So this really brings it home, that fundamental risk-reward asymmetry we saw with Al Zimbabwe.
It's always there. Buyers pay a premium for defined risk and potential leverage. Sellers collect that premium, but accept the obligation and, for calls, potentially unlimited upside risk if the stock soars.
It's really a game of probabilities, understanding time decay, volatility, delta, not just guessing direction.
That's the key takeaway. The power of options is their incredible flexibility. They let you tailor your market exposure, express really specific views on price, time, and volatility. You can manage risk with remarkable precision.
But that flexibility comes with complexity.
It demands a deeper understanding. You need to grasp all those dynamics. You know, a good question to ask yourself as you learn is, under what conditions would I feel comfortable selling a call option, knowing that unlimited risk, versus just buying one? Answering that honestly often reveals how much more there is to learn.
That's a great thought to leave folks with, really understanding both sides of the trade.
Exactly.
That's all for today. Don't forget to like and stack more sats.